Would you want to own a franchise where customers literally pay you to inflict pain on them? European Wax Center has built a billion-dollar empire doing exactly that. And with over 900 locations across the country and a loyal customer base that comes back every 4 to 6 weeks like clockwork. But despite the recurring revenue model and the fact that people will always have unwanted hair, I wouldn't buy a European Wax Center franchise in 2025. And in this video, I'll walk through the story of European Wax Center, why I wouldn't invest in their franchises today, and other similar franchise opportunities where I'm looking to invest my money instead. And if you're new here, my name is Connor Gross. I'm a multi-brand franchise owner and a franchise consultant who helps entrepreneurs and investors to find the right franchise for them. For access to my library of franchise breakdowns and free resources, click the link in the description. Let's go back to 2004, when two brothers, David and Joshua Koba, opened their first European Wax Center in Hoboken, New Jersey. And these weren't your typical franchise founders. David was working in finance and Joshua was in real estate, but they saw something interesting happening in the beauty industry. At that time, most hair removal was happening in nail salons as a side service or in high-end spas that charged very premium prices. And so the Koba brothers realized that there was a gap in the market for a dedicated waxing concept that was both professional and accessible. So somewhere between the sketchy strip mall, nail salon, and the $200 spa experience. And the timing was perfect because this was right as the Brazilian wax was becoming mainstream in America, largely thanks to shows like Sex and the City, normalizing conversations about intimate grooming. Suddenly, what had been a very niche service was becoming something millions of women wanted regularly. And European Wax Center's brilliant insight was to take what was a traditionally embarrassing and an uncomfortable experience and make it luxurious and judgment-free. So they created private rooms and hired only licensed estheticians and developed their own line of hard wax that they claimed was less painful than traditional soft waxing methods. But here's where it gets interesting from a business perspective. They built the entire model around recurring customers. Unlike a haircut that you might get every 6 weeks or a massage that's purely optional and on demand, hair removal is something that has to happen on a schedule because your hair doesn't care if you're having a month financially, it's going to keep growing. The franchise model took off fast once they instituted this revenue model, and by 2010, they had dozens of locations. By 2015, they were approaching 500 stores, and in 2021, they went public, reaching a valuation of over $1 billion. And today, like I mentioned, European Wax Center has over 900 locations across 45 states, and they've expanded their services beyond just waxing to include facials and lash services and a full retail line of skincare products. And the average customer spends about $50 per visit and comes every 4 to 6 weeks. So on paper, it looks like a cash-generating machine. And here's the thing, just because a franchise has been successful in the past doesn't mean it's still the best investment in the market for somebody getting in today. And that brings me to the first reason why I personally wouldn't buy a European Wax Center franchise in 2025, and that is the limited territory availability. Because European Wax Center has been franchising for over 20 years now, and with over 900 locations, they've pretty much saturated all of the prime real estate markets. When I say prime markets, I'm talking about particularly those with affluent suburban areas, people with high disposable income, which is typically the type of area you would want to see to be best positioned for success in a business like this. This is something I talk a lot about whenever we're talking about established brands that have been around for a while, so it's not a problem that's specific to European Wax Center, but it's a dynamic to be aware of nonetheless. If you were to buy a European Wax Center franchise today, you're likely not going to get prime territory in a hot market like Charlotte, North Carolina, or Austin, Texas, or Nashville, right? Those A-tier markets were claimed years ago. So you're either looking at what I call, C and D territories, which are smaller cities, likely less affluent areas, or markets that are already very saturated with European Wax Center existing locations. And the other thing that concerns me about this is that European Wax Center doesn't appear to be slowing down their expansion, right? They're still aggressively pursuing new franchisees, which tells me they're pushing into increasingly marginal territories just to hit growth targets. And as a potential franchisee, you have to ask yourself, if the best territories are already taken and they're still trying to sell me a franchise, what does this say about the territory that I'm going to get? It's like buying into a gold rush after all the good claims have already been staked. So you might find some success, but you're not going to get the prime real estate that made the early investors rich. The second issue is something that might not be obvious at first glance, but becomes clear when you compare European Wax Center to other beauty and wellness franchises, and that is that the average ticket is relatively low for the amount of work involved. Like I mentioned, the average ticket at European Wax Center is typically in the ballpark of $50 based on what the service is, as well as the pricing that, they price based on different locations. So So not only is that a lower average ticket than a lot of other franchises in the industry, but waxing is a fairly labor-intensive lane within the industry, right? Because an esthetician, which does need to be licensed, they might spend 45 minutes to an hour with each client, especially for full body services. So that means you might be generating between $60 to $100 per hour per service provider, which, depending on how much you're paying them, is likely to result in spending a significant percentage of your revenue on payroll. In a service business like this, your labor spend effectively operates as part of your cost of goods sold, since it's going to increase pretty proportionately as your revenue increases. So a service with a relatively low ticket and relatively low gross margins means that you're going to have to drive a ton of volume to drive enough gross profit to then outrun your operating expenses to then be cash flow positive, right? So, and again, with a labor-intensive service like this, doing more volume is a lot easier said than done, because more volume means more employees, which eventually means more space needed, right? You're going to have to open more locations or move to a larger space, which adds a lot of friction for growth that personally I don't want to be a part of. The other complication that comes with low average tickets and low gross margins is that it makes competing in the digital marketing landscape today very, very challenging, because part of what I tend to like about brick and mortar B2C businesses like this is that their sales funnel tends to be very digital marketing oriented. And I like digital marketing, and for a lot of owners that makes sense, because it's not like a B2B business where the owner, has to be out networking and reaching out to people typically to fill their sales funnel. This is something where they need to manage their budget, they need to work with a marketing agency probably, they need to keep their eyes on the sales funnel, but that does fit more neatly into some people's lives. But the problem with a lower average ticket like this is that there is a lower threshold for the amount of money that you can pay to acquire a customer and be profitable at the same time. There might be some digital marketing platforms that you try that you have to discontinue because you're simply paying too much in ad spend relative to the amount of money you're getting from that customer. And because European Wax Center is a recurring service in nature, your CAC to LTV ratio, which is the customer acquisition cost to lifetime value ratio, basically just how much you pay for a customer relative to the amount of revenue you get from them, that might still be decent with European Wax Center, but because of the lower ticket size, you may be recouping that revenue over a period of months or even years. Even if the numbers work out in the long run, it means you might be having to prime the pump with more cash to keep customers coming in the door in the meantime. And all of that is contingent on the durability of the waxing industry long term. And that brings me to my third concern about European Wax Center, which is that the hair removal industry is actually trending away from traditional waxing and towards sugaring. Sugaring is an ancient hair removal technique that uses a paste that's made from sugar, lemon, and water applied at body temperature, so there's no risk of burns. And it's supposedly less painful than wax because it only grabs the hair and not the skin. Here's the big selling point for people, is it's completely natural and biodegradable. You might think, Connor, this sounds like a small trend that'll blow over eventually, but here's what concerns me about European Wax Center, in addition to the data we're already seeing, is that sugaring fits perfectly into where consumer preferences are heading at large, right? People want more natural products, they want less painful procedures, and they want sustainable options. European Wax Center has built their brand around being less painful than traditional waxing, but sugaring takes that value proposition even further. And it's kind of like how Uber disrupted taxis or how electric cars disrupted gas vehicles. The new technology just competed offers a fundamentally better experience overall. And we're already seeing dedicated sugaring spas pop up across the country because brands are growing fast and they're attracting exactly the type of health-conscious, affluent customer that European Wax Center has relied on to build their business. Here's the business reality, is that if you're investing hundreds of thousands of dollars into a European Wax Center franchise today, you're betting that traditional waxing will hold its market share against all things considered, a superior alternative that's gaining momentum, and that's not a bet that I want to make. So, as I've talked about before, I do see a lot of opportunity in the beauty industry overall because many of the business models at their core have very strong fundamentals, right? You're talking about recurring revenue, growing demand for self-care services, and many are more recession resistant than you might think. Whenever you're evaluating a business opportunity like this that is more discretionary in nature, it should elevate the standard by which you evaluate the market in which you're doing business. Because there are some businesses out there that could work in just about any market where there are people, but in high-end service franchises like this, it's very important to make sure that you get prime territory with a deep market of affluent individuals with larger budgets, higher willingness to pay a lot of money for self-care. And it's also important to look at the key metrics, like, as we talked about, the lifetime value of a customer, which you calculate by multiplying the ticket size by the frequency that the customer uses the service, by the length of time on average they tend to be customers. And then you also have to look at the customer acquisition cost, which is the cost per lead times the conversion rate. So if you convert 1 out of every 3 customers, you would multiply the lead cost by 3 to get your customer acquisition cost. So you need to understand how these numbers interact, and also the cash conversion cycle, how much cash you're going to need to grow over time, and also how much volume the business will need to drive to be profitable and create value, and what kind of operational friction this might present between personnel, real estate, etc. And very important, as we discussed, that if you get into something in beauty, it needs to be part of the industry that is growing in market share and not shrinking, because there are plenty of risks and challenges that come with a business like this. And the last thing that you need is to be doing business in a shrinking market, and that's just going to amplify all of these risks and challenges overall. So while European Wax Center has built an impressive business that has clearly made a lot of franchisees wealthy over the past couple of decades, I don't think that it's the best opportunity for somebody getting into franchising in 2025. Nonetheless, there are still plenty of great opportunities out there that I evaluate as potentials to add to my franchise portfolio, and I also help others to find and evaluate to potentially add to theirs as well. If you have at least $100K of liquid capital to invest and you'd like my help finding the right franchise for you, especially in the beauty industry, click the link in the description to book a one-on-one strategy call to get started. And as always, please like this video, subscribe to this channel, and leave a comment letting me know what franchise you would like to hear about next.